Hey everyone, Eric Dutram here with the latest edition of the Dutram Report, the podcast on ETFs and more. Today we have with us Derek Voynar, head of ETFs at Hartford Funds. In this edition, we talk about international markets, what's been going on around the globe in the world of finance, and Hartford's approach to long-term investing beyond American shores as well. So if you have any questions or comments, make sure to send them in to podcast@zacks.com. And don't forget to find the Dutram Report on iTunes and give us a review there as well. But stay tuned for my chat with Derek right after this. Okay, Derek, thanks for joining us. A lot of people these days are focused on investing in the U.S. in the age of Donald Trump, but you at Hartford, you guys are seeing some values in the international markets. Why is that?
Well, clearly for most U.S. investors, U.S. market, U.S. equity market, it seems to be the most important one. It's the one that is closest to home, and investors still have a home investment bias. We, however, believe that the overall equity opportunity around the world is much broader than the U.S. equity markets, and we encourage investors to consider adding international equities to their portfolios. Certainly, it is an important question to consider in context of clients' objectives and risk expectations and tolerance. But nevertheless, for most investors, international equities and inclusion of some portion of international equities in the portfolio can offer some benefits.
So there's obviously a lot of talk about developed versus emerging. Are you viewing one of these types of markets as a more compelling choice at this time?
We're looking at it from strategic perspective. So most investors who want to invest in equities should really start by considering the overall equity universe. And when you think about it, depending on which measures you apply, often if you look at a very traditional breakdown of equities, let's say using MSCI benchmark, the market capitalization of U.S. Represents roughly 53% of the global equities. The remaining half is split roughly 37% being attributed based on market capitalization to developed markets and only 10% to emerging markets. So as a starting point, that's usually a consideration that clearly, while U.S. is the biggest part of the portfolio, should for most investors be core of the portfolio, developed equities are very meaningful in that context. Emerging markets, while they provide perhaps some outsized gain opportunities, they also contribute the most risk. So they should be considered in that context.
Right. And, I think a lot of U.S. investors probably don't have more than a third of their portfolio in developed markets. And I'm sure when you're talking about developed markets, a lot of that focuses in on Europe. We're seeing a lot of concerns lately from Europe in terms of Brexit and sort of just the general political uncertainty going on over there. Do you have any comments on that? Should investors be worried about that these days, or is that kind of more of a passing issue for investors?
I don't think risks and equity risks are ever a passing consideration. They should always be carefully weighted in context of objectives and tolerances. And I think the political risks that we've seen recently, whether in Europe or perhaps with the outcomes in U.S. elections that have not been completely predicted by all investors, I think that those are the considerations that can be addressed on a strategic level.
Okay. And just one other kind of broad picture question I had. We've heard a lot about the strong dollar as of late. A lot of investors have been kind of focused in on this whole idea of currency hedged investing. It's become extremely popular lately. Do you have any advice or tips for people out there who, might be thinking about either currency hedging or taking into account currency risk?
Well, currency risks can be a meaningful contribution to the portfolio from perspective of perhaps diversification. There are some investors who choose to hedge currency risk and really do not want to have exposure to perhaps currency risks associated with investments in non-U.S. equities. From our perspective and the portfolios that we deliver to clients through Hartford Funds multi-factor ETFs, we do not hedge currencies. However, we definitely consider allocation to various countries and currencies as part of our risk-optimized design characteristics for the underlying indices. So effectively, we do not believe in taking any outsized currency risks, but we do not hedge them. We simply try to spread the currency exposure across multiple currencies.
Yeah, let's talk a little bit more about some of the risk factors. I noticed in some of your team's research, developed markets, low volatility stocks may be expensive compared to a lot of other ratios and other types of stocks out there. So why do you think these low volatility stocks are a bit more expensive these days? And, what are some other areas you're seeing in the developed markets that might be less expensive? So I guess what are you guys tilted towards these days in terms of, characteristics and other value metrics?
I think that the question of valuation is a good one, and it's one that should be very carefully considered by all investors. We believe that for long-term portfolios, entry price matters, and entry price really means being able to acquire securities that are on a relative basis to perhaps other securities, but also to their own past histories, valued relatively better. So if we look at today's valuations, U.S. equities are probably somewhat elevated, although there have been many instances in history where U.S. equities were far more rich in terms of valuations. Developed markets at large don't seem to be elevated based on analysis of their historical valuations. So I think that on a relative basis, they're probably close to what their historical averages have been. It doesn't mean that they don't have risks associated with valuations, but they don't appear to be overly expensive. Regarding your specific questions on low volatility securities, I think that we consider in constructing our ETFs and the indices that underlie them a variety of measures and factors, including low valuations, including momentum characteristics of individual stocks that are considered, including quality of the balance sheets of the companies that are being considered. And from low volatility or lower risk considerations, we look at it from a correlation perspective. So we do not select securities within the indices that are underlying Hartford Funds multi-factor ETFs based on low volatility of individual stocks, but we certainly bring the volatility of the overall index and the portfolio that tracks it through careful considerations of correlations between the securities.
So is it fair to say to get a lower volatility for your products, you look more at this correlation as opposed to, say, standard deviation of or beta or some of the more what some might call traditional volatility factors? Is that fair to say?
That's fair to say, Eric. I think that there are two general approaches whereby one can achieve lower volatility. One of them, more traditional one, is if you look at the universe, one could rank all securities based on their relative volatility and simply select those that themselves are less volatile. In our RODM ETF and the index that underlies it, which is a Hartford multi-factor developed markets ex-US ETF and the corresponding index, we don't do that. We, on the other hand, carefully evaluate the correlation between the stocks that are making that index or comprising that index, and the selection of those securities is based on value, momentum, and quality characteristics.
Yeah, let's talk a little bit more about the fund for investors out here who are looking to get a bit more exposure to developed markets, RODM, as you mentioned. So what is the breakdown among those factors that you just talked about in terms of momentum, some of the value and growth characteristics? Is it a, kind of a equal weight among those factors, or is there kind of a tilt towards some rather than others in certain times of the market?
Well, in our general approach, we believe that value or valuation and value entry point that is basically assigned to a security at the time of purchase is probably the most meaningful predictor of long-term return. So based on that, the value factor receives 50% of score. The other two factors, momentum and quality, receive respectively 30% and 20% score. So overall, factors score for each security that is being added to the index and then is being held by the ETF has 50% allocation to value, 30% to momentum, and 20% to quality.
Okay, so you have more of a value tilt and also a kind of a lower correlation focus as well. What is the impact of this sort of strategy on the risk return, and then also the sector breakdown when you compare it to other larger benchmarks out there?
Let's start from sector breakdown. We do guard the index and the ETF from deviating from the sector allocation too significantly. So in that, the index rules restrict at any semi-annual rebalance the deviation from sector allocation by 2%, so 2% up, 2% down. Clearly, post the rebalance during the subsequent 6-month period, the sector can deviate a little bit more. So we, in most cases, observe up to 3% deviation from sector allocation. But given the 10 or 11 sectors that are being considered, generally, the sector allocations are not significantly different on average from those of traditional market cap indexes.
Yeah, what is the benchmark you guys are comparing it to? MSCI World ex-US Index?
Correct.
Okay.
We compare ourselves to MSCI World ex-US.
So right now it's kind of tilted, at least I'm looking at the most recent fact sheet here. Healthcare, real estate are ones where you're slightly more overweight, and then energy materials seem to be slightly underweight. But what about for the country breakdown? Do we see a similar sort of restriction on the deviation from that perspective as well?
On the country side, we do also have constraints as to how far allocation between the countries can vary. Those allocations have a little bit more leeway to move. So generally, what we'd see is that we don't believe in concentration. So the largest country would typically be smaller in our index and in our ETF than in a corresponding market cap weighted index. And then subsequently below that, so below the largest country, which in this context is Japan, the other countries may deviate by roughly up to 5%, up and down 5% from the allocation that we would attribute purely based on market capitalization. And then the farther down the size of the country we go, those deviations get smaller. What I'd like to, however, to point out is that the allocation really are measured versus the market capitalization weighted universe that we construct. So if you compared our index versus a MSCI benchmark, which is a reference benchmark for us, or any other, for that matter, world ex-US benchmark, there will be some small differences, but they won't be meaningful.
Okay. And I also noticed that the market cap breakdown of the component securities is actually pretty different for your product as opposed to the reference index. For the most recent fact sheet, I'm seeing just about 3% in companies that have a market cap greater than 100 billion, and that compares to about 16.5% for the reference index. I noticed also on the fact sheet multinational exposure. It's kind of a tilt away from that. I think a lot of investors might think, these might be among the safest, more value plays, but it appears the research hasn't bore that out. Maybe you can talk a little bit about this tilt away from these multinational giant caps and towards the small and mid caps out there.
Correct. I think you've observed very correctly that the allocation to the largest companies within the universe, so we look at them as those companies that are 100 billion in market capitalization or greater, is somewhat lower than to any reference world ex-US index. In our case, based on the fact sheet that you quoted, it's 3.1% versus similar allocation for MSCI World ex-US for the same period, roughly 16.5%. The reason for that is that we do not believe in concentration of investments in any particular security. So we do have position limits that at each semi-annual rebalance bring down allocation to the larger individual stock below 75 basis points, so less than 1% allocation. And when you think about that, basically in market cap approach, where the largest securities get the largest allocation, these could be in excess of 1.5%, sometimes close to 2%. So by design, if you will, we underallocate capital to some of the largest market capitalization-based securities. And from our perspective, this is a very much risk approach. We do not believe in concentrating capital. Therefore, we have ability to spread that capital across a broader range of large companies and mid-sized companies that are part of the same universe.
So what if some of these changes, it seems like there's a lot of differences between this product and sort of the reference index. How has this impacted the overall risk-return profile when we look at, say, year-to-date or even 1 year for this fund?
Well, the fund has actually, and the index, performed quite well. So from perspective of 1 year performance, we've had, and since inception performance, we've had very good results. There are, however, differences during particular periods of time. So I think the considerations here are being able to take a very long-term view. We don't believe investors should be looking at assessment of multi-factor portfolios and Hartford multi-factor ETFs over a course of any short period of time, whether that be a quarter or a year. Really being able to buy securities at the rebalance time that have good valuation characteristics, momentum, and quality characteristics, and then understanding that risk characteristics are designed and they under-allocate capital to the largest companies, results in periods of outperformance and periods of underperformance. We believe that in the long term, the odds are good, and effectively the design parameters are creating a product that has characteristics that will benefit investors with patience and long-term outlook.
So it sounds like you think this is a long-term holding, but how do you think it fits into your average investor's portfolio?
Well, most investors have ability to access investments today through both very much traditional active portfolios, mutual fund portfolios, very much market capitalization weighted, inexpensive, passive market cap weighted ETFs or mutual funds, index mutual funds, as well as portfolios like ours, multi-factor portfolios that have effectively systematic exposures that differ and deviate from market capitalization weighted portfolios, but do it in a systematic way. We think that these portfolios effectively add to the toolbox for most investors, and investors who are patient and like to use them as a core will have a potential to benefit from that. What it provides them a core portfolio that, on one hand, has certain risk characteristics. In case of RODM, this portfolio has generated less risk or volatility associated with holding that portfolio was lowered by roughly 15% versus the market capitalization-based universe, and that's by design. And from perspective of outperformance, there is a potential for outperformance. It's not going to come throughout every period, and there have been periods when the outperformance has been stronger, and there have been periods when outperformance has been lesser. And then what the investors can do, then consider any additional, perhaps tactical views that they may have to overlay around these core portfolios.
Okay, Derek, I think that's about all the time we have. Thanks for joining us. I think this is a great discussion on international markets and your fund RODM as well. Thanks.
Thank you very much, Eric.
Well, hope you enjoyed this edition of the Dutra Report, and make sure to tune in for more interviews and discussions on the world of exchange-traded funds in the future. And for my thoughts on the ETF world, make sure to go on over to Zacks.com and check out the ETF Investor Service, which includes my top picks and commentary on the markets. And don't forget to find the Dutra Report on iTunes and give us a review there. And let us know if there are any topics or questions you have for us at podcast@Zacks.com, my Twitter page @EricDutram, or leave us a comment on Facebook too. And be on the lookout for a new edition of the Dutra Report each and every Thursday. And until then, for Zacks.com, I'm Eric Dutram.